This is not financial advice. I'm recording my thoughts about Marqeta. Marqeta is an open API card issuing and transaction processing services company that has customers like Block, Google, Uber, and Coinbase. They're a very fast growing company with more than 200 clients. In 2021, they made about $500 million of revenue, which represented 70% growth year on year. But when I looked into the past 2 quarters, the revenue decelerated. The year on year growth reduced from 70% to about 50%. So even this entire year, they're only projecting that they could grow about 50%. So if I want to take an investment decision to whether to buy this company or not, I need to look at its projection 5 years out. And for that, I cannot assume 50% growth, right? Because if they're growing 50% now, when they're smaller, once they get bigger and bigger in the coming years, they will grow slower, right? So I'm going to assume a 40% growth, which I think is still optimistic for this company, and they will make about $2.75 billion of revenue. From 500 million last year to about 2.75 billion 5 years out. That seems optimistic. When I look at their gross margins in the previous years and even in the recent quarters, it's about 40 to 50%. So based on that, I can only assume a net profit margin of 15% or less. So I'm going to assume 15%, which would give them a net income of about $400 million or $0.4 billion. For a company that's growing in the 40% range and has a net profit margin of 15%, I can assign a multiple of 25 or less. So to be optimistic, I'm going to assume 25 multiple. This company would be worth about $10.3 billion market cap in 2026. Currently, they have about 545 million outstanding shares, but I'm assuming that they're going to dilute the shareholders in the coming future because they're still not profitable. So if I assume just 2% share dilution in the next 5 years, year on year, the number of shares in 2026 would be about 600 million. So when I divide the market cap with the number of shares, I get about $17 stock price. But now they are at $8, right? That's about 2x, but we have a lot of execution risk. I'm going to list 2 risks that are of importance. The first risk is they're too reliant on Square or Block for their revenue. Almost 50% of their revenue comes from Block, right? So Block can squeeze the margins of Marqeta or even completely eliminate them, which would be detrimental to Marqeta. The second is their main customers also include companies like Affirm, which are in the buy now pay later business. So their success also depends on the buy now pay later concept success. In addition to these 2 risks, there is always that execution risk. They have to get profitable and grow at 40% or more in the coming 5 years, right? So a 2x reward with the risk that I'm taking is not too good. So I'm going to stay away from Marqeta.